Chapter 8, DeFi Fundamentals. Section 4, Liquidity Pools. A liquidity pool is a smart contract that keeps reserves of two or more tokens, so traders swap against assets already in the pool instead of waiting for another person to take the other side. That means no order book is needed, which is why decentralized exchanges can offer always-on trading. As long as the pool still has reserves, it remains usable. AMMs don't use bids and asks to set a price. Instead, many pools follow the constant product rule x times y equals k, where x and y are the token reserves. When a trader adds one token and removes the other, those reserves shift, and the new reserve ratio creates a new implied price. In practice, fees and rounding mean k stays only approximately constant, but the core idea is the same. When you add assets to a liquidity pool, you become a liquidity provider by depositing equal value of each token at the start. Not necessarily the same number of tokens. In return, you get LP tokens, or a position record, which simply represents your proportional share of the pool. As traders use the pool and pay swap fees, the reserves grow over time, and that makes each LP share more valuable. A liquidity pool follows a simple loop. A token pair is created, liquidity providers deposit both assets at the current ratio, and traders swap against those reserves while fees build up in the pool. When an LP exits, they redeem their share of whatever the pool holds at that moment, so the withdrawal may not match the original deposit mix because trading has changed the balance over time. Start with 10 EH and 20 W000 USDC, so the pool price is 2 W0000 PPAF 8s, and the constant product is 200 W0. If a trader removes 1 ETH, the pool drops to 9 ETH, so USDC has to rise until 9 times Y still equals 200 W0, which gives 22, 2W00, 2W2, 2W. 22 USDC, that means the trader adds 2W0 to get 1 ETH. Ignore DeFi's and its IRA. A common point of confusion is that there are really three prices in play: the starting spot price, your average execution price, and the pool's final price after the trade. In this example, the pool starts at 200,000 TC per ETH. The trader ends up paying 222 USDC for 1 ETH on average, and after the swap, the pool's marginal price rises to about 2,469. 14. The bigger the trade is relative to the pool, the more it pushes the price goes, which is co. Pool prices can drift after a big trade, but they don't stay disconnected for long. If the pool price moves away from the broader market, arbitrage traders step in to buy where it's cheaper and sell where it's higher, earning the gap as profit and pushing the pool back into line. That same rebalancing changes the reserves, so liquidity providers end up holding a different mix of tokens as market prices move. Impermanent loss is the gap between what your liquidity position is worth and what you'd have if you had simply held the tokens. For example, if you deposit 1 ETH and 2,000 USDC and ETH later rises to 2,500, just holding would be worth 4,500 USDC, but the pool may end up around 4,572. 14. Because arbitrage traders buy ETH from the pool, leaving you with less ETH and more USDC. If prices move back toward the original ratio, that gap can shrink. Fee income is the main reason people provide liquidity, but those fees have to be strong enough to outweigh the risks. A high fee rate by itself does not guarantee a good return, because what really matters is how much trading happens, how prices move, and whether impermanent loss eats into those earnings. And beyond market moves, there's also protocol risk, so smart contract failures can turn a promising pool into a losing one. Not all liquidity pools work the same way. Constant product pools are the standard choice for general trading pairs, but bigger trades can move the price more and create noticeable slippage. Other models change the pricing curve to fit specific situations, like assets that tend to stay near the same price, or pools where liquidity is focused within chosen price ranges. That curve shape matters because it affects execution quality, capital efficiency, and the risks liquidity providers take on. Before providing liquidity, check more than the quoted price and headline yield. What matters is your actual execution price, the pool's fee tier, trading volume, and price impact. And remember that when you withdraw, you receive whatever the current reserves contain. not necessarily the same mix you deposited. It also helps to treat LPing as a real risk decision, not a passive one. Smart contract bugs, governance failures, Oracle issues, and economic attacks can all affect outcomes. Good LP deck